Good afternoon and welcome to today's Arizona Opportunity Zones Guidance Review. My name is Shawn Neidorf. I'm the Senior Vice President for Research here at the Arizona Commerce Authority and the person who oversees Opportunity Zone efforts for the state of Arizona. I'm here with an illustrious panel that I will introduce shortly, and we thank you all for being a part of this event today. There we go. I want to do a really quick overview of Opportunity Zones first. As many of you know, they were created through the Tax Cuts and Jobs Act that was signed into law in December of 17. And it's a measure that provides capital gains benefits to investors to encourage them to sell their passively held investments and reinvest that money in property or businesses in lower income communities that are known as Opportunity Zones. I do have a little note here that requires the use of an intermediary vehicle called an opportunity fund. We'll be talking about that more as the webinar proceeds. Governors nominated a quarter of each state's qualifying low-income census tracts for Opportunity Zone status, and the U.S. Department of Treasury certified those zones. Arizona submitted its zones on March 21st, and we were among the first states to be approved on April 9th of 2018. So we've been at this for a little more than a year. I want to note that our tracts are urban, suburban, rural, and tribal, and that every county in the state has at least one. This is a map. Some of you may have seen our Arizona Opportunity Zones map. By the way, this entire presentation, including the slide deck, will be available online later, and you'll be able to click that little orange text in the lower left corner that will take you directly to the map. One of the things that's always interesting about this map is that when I showed it in an urban community, the first question I get is, why is so much of the Opportunity Zone land rural? When I show it in a rural community, the first question is, why are so many of the tracts in urban and suburban areas? The simple fact is that the census tract is the unit of analysis, it's the unit of selection, and those are meant to represent a certain population size. In an urban area, that's going to be a tight little square or rectangle. In a rural area, it's going to be a large abstract shape. That's simply a function of how sparse or dense an area is, but we were asked to choose on the basis of tracts, and the selection was proportional across the state. To very quickly review just some of the fundamental tax benefits. Let's say you cash out of an investment that you had this year and you have capital gain. You are able to defer paying the capital gain tax at the federal level on that gain. It doesn't come due until December of 2026, so you'll be paying it in the spring of 2027. If you get your money into an opportunity fund by the end of 2021, so that it's in there for 5 years, by the end of 2026, you will pay on less of the capital gain than if you had not done that. So if you had $1 million capital gain and you had it in a fund for 5 years, you would pay on $900,000. If you got your investment into the opportunity fund this year, such that you were able to have 7 years in the fund before the end of 2026, you would get a 15% reduction, and you would pay taxes on $850,000 in capital gains instead of $1 million. But honestly, the big payoff is on the second investment. Now that you've made your investment in the fund, you hold your investment in that for 10 years, and when you sell that investment, you can elect to raise your basis such that it goes to market value, and you do not have a capital gains payment on that second subsequent investment that you made in the opportunity fund. This is right from the statute. This is the part we've known all along, but there's been lots of other things that we've been waiting to learn. I do want to share with you real quickly a tool that we have here at the Arizona Commerce Authority, and we're calling that the Arizona Opportunity Zones Network. You are the first folks to hear about this. This is a new tool that allows you to search for experts, to search for opportunity funds, to search for projects and businesses seeking funding, and to look for land that is either for sale or for lease. This is something we're really excited about. As much as you can go in and search, you can also post your own projects, your own businesses, your own opportunity funds, your own expertise. So we really would like you to go and check that out today. And again, you'll see that there is a link to that at the bottom of this slide here. But in addition to that, if you actually just go to our website, azcommerce.com, and search opportunity funds, you will see the Arizona Opportunity Zones Network. We really want folks to take advantage of this as a way to maximize the impact of opportunity zones here in Arizona. So I wanted to talk a little bit about opportunity zone guidance. If you've looked at the opportunity zone legislation, it's really quite short, but at the same time very complicated. Treasury guidance is critical to deploying opportunity zones. opportunity funds into the zones, because we just didn't have enough off the statute itself. So there's a first tranche of guidance that was released in October of last year, and which had, of all days, a hearing on Valentine's Day of this year. And that guidance gave us a little bit to get started with. There was some opportunity fund paperwork that they released, so funds actually knew how they could form. There were some provisions that made multi-year projects feasible and rehab projects a little more desirable to do. And it made investing in businesses that are largely, but not entirely in a zone, feasible. So we just got a very long-awaited and eagerly anticipated set of guidance on April 17th. It is 169 pages of an awful lot of stuff. And what it does in there is it clarifies how several key provisions and rules apply to investments in operating businesses. That was something we were all waiting on. It addresses how to invest in projects on leased land, which is especially critical here in Arizona. And it discusses the tax implications of interim gains and the rules for reinvestment. There is a hearing scheduled on the second tranche of guidance on July 9th. So I want to, before I go any further, introduce today's panel, because it will not be me that you hear from today entirely. We are very fortunate today to have with us 4 members of the Opportunity Fund community. We have Chris Loeffler and Brion Crum from Caliber. We have Quinn Palomino and Brett Maidman from Virtua. We have attorneys Marc Schultz from Snell and Wilmer and Dan Gauthier from Rose Law Group. We have Quannah from the Salt River Pima-Maricopa Indian community, where she works in economic development. And we have philanthropic leaders who've been engaged in looking for ways to use opportunity funds for social utility projects. And those are Terry Benelli from Phoenix LISC. It's LISC Phoenix, isn't it? I apologize, it's a bit backward. And Suzanne Pfister from Vitalyst. So our agenda today is that we're going to go through the guidance and have a moderated discussion for the first 3/4, and then we're going to save a half an hour for your questions. Now, if you're interested in how to submit questions, please look for the question and answer, the Q&A icon on the bottom of your screen. Click the icon to open the Q&A window, type your question into the Q&A box, and click send. We have a member of our staff here who is reading your questions and organizing them, so that we will be ready for them when we are finished with the moderated discussion, and we appreciate your interest. So I'm going to start by talking about the provisions related to operating businesses, because these were some of the most eagerly anticipated parts of the guidance. The first tranche of guidance said that at least 50% of the gross income of a qualified opportunity zone business had to be derived from active conduct of trade or a business in the opportunity zone. Now, the statute itself said everything that I just said, except in the opportunity zone. And the addition of that language really confused a lot of people. So the second tranche covers the options for how you comply with that. And it can be on the basis of the share of service hours performed in the zone, or the share of cost of services provided in the zone, or the tangible property and management or operations in the zone are needed to generate 50% of the business's gross income, or a facts and circumstances test. So they gave us a range of options. And I promise as soon as I finish with the operating business section, we're going to ask our attorneys and our other experts here to pick this apart. The other things they addressed was what would be reasonable working capital and what do you do about inventory in transit. So the first tranche of guidance provided a 31-month safe harbor for capital used for an opportunity zone business to acquire, construct, and or improve tangible property. This cash is considered reasonable working capital for the opportunity zone business test. The second tranche expanded the coverage of that safe harbor to expenditures related to development of a trade or business, including payroll, inventory, and rent. So you could use this safe harbor for more than just building a property, you could now use it to build a business. The second tranche also clarifies that inventory that's in transit, raw materials coming in, finished goods going out, that does not fail to qualify as being used in the opportunity zone just because it must move from a vendor to the zone and from the zone to a customer or client. They also talked a little bit about intangible property. The statute requires that a substantial portion of intangible property of a qualified business entity has to be used in active conduct of a trade or business in the zone. The second tranche of guidance defines substantial as 40%, but it doesn't really tell us how we are to measure that. So I want to pause here and put some questions to our attorneys in the room. So I'm going to ask you to please put these operating business rules in perspective. What types of companies are most likely to be able to take advantage of opportunity funding now that we have this guidance? Who will not be able to take advantage? How might these rules apply to existing businesses, especially those who were around before 17? And finally, is there anything we're waiting on regulations-wise that will be important for operating businesses? Dan, Mark, which of you would you like to start?
Well, I could, this is Mark. I apologize, my allergies I'm having a bad allergy day. But the application we see for this really venture capital startups, much easier to meet some of the requirements, especially, you didn't talk about this, but the 70-30 test, 70% of your assets have to be good assets. So that's where we see the application is in the startup area. One area where you couldn't do this, and that would be if you wanted to finance a bank, because a bank makes loans, and loans would be bad property with respect to the 5% test that I know you're going to talk about.
Did you want to add anything?
Yeah,
Dan, to that?
this is Dan. Shawn, if you could go back just to the one more. Yeah, so just to kind of pick on these safe harbors, the compliance options that you see on your screen here. Prior to this guidance, what we were really limiting the application to businesses is to a business that produces a physical thing in a zone was essentially all that we could really confirm relatively confidently that would apply here. These safe harbors do significantly, and I agree with Mark that venture capital startups will be a good application for this, but they significantly expand that. So we have basically the first test here is that at least 50% of the service hours for the business are performed in the zone. So if you have a newer business that is located in the zone, simply hours within the zone will qualify you for the most part. Now I say a new business because it's going to be a lot harder for an existing business to do that. So I think I'll wait until your next question for that, Shawn. But I just wanted to pick down on these because I think that it does make it a lot easier for businesses. But as Mark mentioned, it's not a...
Yeah, one thing to note about this slide is it also applies to independent contractors. So you're looking at all the employees that you have, as well as independent contractors that are providing services for you. So you would have to take into account how many hours they spend performing services for you within the zone and without the zone in order to apply those, those first two tests.
Is there anything we're still waiting on for operating businesses?
I mean, I'd like to find out how you figure out 40% for intangibles. If I have software, do I have to 40% of my licensees have to be in the zone? They were very vague. They were very vague on how you apply that test.
Right, and we may get to this later, but as far as measuring the substantial improvement, which I know we'll get to in a bit, but an asset by asset classification versus an aggregate measure for a business to measure how it's substantially improving tangible property is likely forthcoming.
Yeah, I mean, one of the areas that I spoke to EIG about, and that is on exit for an operating business, when you sell assets, some of your assets will generate ordinary income. And after 10 years, that ordinary income would not get tax-free treatment the way this is written.
Just throw a real estate guy's perspective in there, just because we're doing a lot of deals that do affect operating businesses.
And this is Chris.
This is Chris Loeffler from Calvert. We're seeing a lot of excitement around putting a incubator accelerator in an opportunity zone as a tenant. So something that can generate new businesses, and therefore those businesses would have a chance of benefiting from this program. Whether or not their business model would fit, we don't know. And then the other thing that I'm seeing a lot of is local businesses. People who do want to own their companies for long periods of time, want to expand into their second or third restaurant location, that kind of stuff. So.
Well, let me turn to you then and ask, the deals we've seen so far have largely been related to real estate development. Do you think the new rules pertaining to operating businesses will make funds, including yours, more likely to invest in operating businesses? Why or why not? And if yes, what types of businesses would interest you and which are you more likely to avoid?
So I'll channel the perspective that I got last week at the SALT conference in Las Vegas. There was about 2,000 investors, and I, on a regular basis, heard, based on the new rules, that they were interested in opening funds to fund into operating companies. So I heard that was a pretty regular comment from a lot of pretty high-level venture capital and institutional investors, et cetera. They were just waiting on this. They got it. They know what they need to do. And I think that you'll start to see a lot of funds form in terms of investing in operating companies, as well as funds that would work with a fund like ours who says, okay, we want to invest in the business. You guys own the real estate. We work together. So that's what I've seen so far.
Quinn or Brett, would you like to weigh in on this?
Yeah, this is Quinn over at Virtua, and in agreement with that. And just while the recent clarification is really valuable and it makes it easier to invest in businesses and operating businesses, you know, our main line of business is real estate, so residential, hospitality. Our family offices, our institutions that invest, there's still a hesitation on the business side. Real estate is something they can touch and feel. So we definitely see at least the pulse amongst our family offices and ultra high net worth investors. Real estate is something they still feel much more comfortable.
So it sounds like this is not going to push you into the operating business side.
It's not an area of our focus, and then just based on the appetite of our investors.
It's very hard to do a mixed fund, because if you do a mixed fund, then the investors say, well, do one thing or do the other, do real estate or do operating companies. So I think what you'll see is, at least from our real estate share, is that we'll do lease incentives and such that can help operating companies, and we'll partner with other operating company funds, but you'll see a lot of separation.
Are there any things in the operating business side that you're just like, nope, don't want any part of that?
Not really, not for me at least.
All right, well, I am going to move us into our next topic, which is leased property. I will tell you honestly that I personally call Treasury about every 6 weeks to nag them about this question. And shortly before the regulations came out, the person I had been nagging on a routine basis said, Shawn, all I can tell you is you'll like it. And I said, okay, that's all I needed to hear. So I think we are pretty happy with it, and I'm going to run through this really quickly. Excuse me. The proposed regulations in the second tranche make it clear that opportunity funds may invest in businesses operating on leased land or invest in leased tangible property. Leased tangible property may count as qualified opportunities on business property for purposes of the 90% asset test, and at the fund level, and the 70% asset test at the business level. These are tests that ensure that funds are putting their money in qualified assets in the zones. The lease has to start after December 31st, 2017. The lease must be market rate, and substantially all of the leased property is in an opportunity zone during substantially all of the lease period. And I think we all are reasonably certain that the land is not going to get up and move, so this is a little bit more of an issue when it comes to equipment. Additionally, there is no original use requirement for leased tangible property, nor is there a substantial improvement requirement for it either. These are rules about what needs to be done to qualify as a proper investment, and they don't apply here. The lesser can be related to the opportunity fund or the opportunity zone business, but there are restrictions on that generate pros and cons. I started trying to make a slide for those and said, you know what, this is the part where I say call your lawyer. Leased tangible property may be valued in accordance with GAAP or on a calculation of the present value of the lease payments, but notably, opportunity funds must use the same approach for all leased property. So I want to throw this over to Quannah from Salt River Pima. All of these rules apply to all leased property. These provisions were especially important to tribes. Could you explain why and how these rules will affect tribal opportunity zone development opportunities? I'm also curious if you have any deals or projects that are ready to go, if there have been investors or developers on the sidelines waiting for this guidance, and whether you expect to see more tribal development kick off soon. So what should we be looking for? What does this mean and what should we be looking for?
Great, thank you. This is Quannah. For the Salt River Pima-Maricopa Indian community, this was really important for us because the land that's available for development isn't available for fee simple purchase. It has to be through a short-term or a long-term lease. So we were eagerly awaiting the second tranche. It has clarified now that we can have these opportunity zone investments on leased properties in the community. And I just would kind of echo as far as for both the state of Arizona and nationally, it's not just tribes that are benefiting from this kind of clarity. Certainly states that hold due leases, institutional, educational organizations that have leased land, cities, counties, etc. Yes, and we do have several developers who have indicated that they were waiting on this clarification in order to kind of move forward with kind of seeking this investment. What we see specifically for the community is that leases on trust land, especially for the way the land makeup is in our community, is those take a long time. So what we see happening, we think, will be subleases, ground subleases that will occur as part of an existing master lease. That would be a more kind of a faster way to get land under control and to give the maximum time to kind of reap all the benefits. The community is looking at projects from a government standpoint as far as projects that directly benefit enrolled community members, as well as working with developers cooperatively to expedite their projects or work with them in any way that we can to help them get these investments.
So what kind of projects would those be? What kind of things would be of benefit to the community members?
So housing is a big issue for us, housing for community members. We do have some brownfield redevelopment projects that we would, that are in the pipeline now that we would like to move forward on. And those type of projects that directly impact community members.
Okay. So I want to jump back to our attorneys. If you could talk, sort of take a little bit of a broader view and talk about how the lease provisions apply more generally. Who are they going to help? And is there anything missing in the regs when it comes to leases?
Well, I could do some background on how we got here. In order to have good property, you have to have tangible property acquired from an unrelated person by purchase. And so the issue was that a lease is not a purchase. And so the problem we had was with these ground leases, until we had these regs, you had to take this into account as bad property. And with respect to the opportunity zone business, you can only have 30% bad property. So if you're valuing a 75-year ground lease and taking the present value of those payments, it's pretty significant. And if you have to count that as bad property, you probably were going to fail that test, or you could have. So what this has done now is it says that if you have a lease and it's got to be a market rate lease, and it has to be after December 31st, 2017, you get to count that as good property. And so it's very, very helpful. It also says you don't have to substantially improve the property, but so a lot of people are trying to figure out, how do you gamesmanship this, because you don't have to substantially improve. But the key thing here is that, like, if I were to lease you a rental apartment building, in order to use this provision, it has to be a lease for tax purposes. If that lease is too long, it's seen as a sale and not a lease. And so if it would be a sale, you have to substantially improve. So how long can you really lease an apartment building and still have it a true lease? 20, 30 years tops. No. So we look at that as anyone that's going to, lease a building would still have to undertake some improvements. So, at least in terms of the fact that you don't have to substantially improve, where a lot of people are focused, we don't see that as some way to circumvent this the system.
Did you want to add anything?
Sure. This is Dan. I echo everything Marc said, and I think as far as the requirement that each lease is on market terms, I think what's missing is exactly what factors are going to come into play when valuing that, whether it's going to be simply rent, price, term, presence of an option to purchase, things like that, and potentially anti-abuse rules that'll come into play in trying to prevent gamesmanship, as Marc put it.
Is this a good option? And I didn't tell you guys about this one in advance, but I've been getting this question. Is this a good option for an operating business that wants to do a subsidiary or a second major facility, but they want to do it in a leased property?
Well, I mean, a lot of operating businesses lease their premises, so that would be an asset, and a good asset now.
So this would be,
yeah,
this
it's
would
very
enable
helpful.
something that they were holding back
Yes,
on.
absolutely.
It could have been something that kicked them out before, but now it's turned to the good side.
One other thing, this is Chris from Calvert on the real estate side, stacking incentives for all the economic developers that are all now listening from the different cities. This is now a big deal because being able to get certain city and local incentives to do development required us to lease from the city or from the municipality. And now you can actually do that and stack those incentives. So that's important because some of these projects do need those incentives to be able to go forward.
And the other thing is that it does allow for related party leases where you can have good property. You can't have a related party sale that generates good property, but a related party lease can generate good property.
All right, we're going to turn to real estate now. One of the things that this tranche of guidance did was address the concept of original use. And according to the second round of guidance, original use for tangible property begins when the property is placed in service for purposes of depreciation or amortization. This was really important because there was a ruling that came along with the first tranche of guidance that said land can't have original use because it's perpetual, which sounded really almost kind of interesting and philosophical, but also a little terrifying because no one really knew what that meant. So they kind of almost walked that back a little bit. And also buildings that have been vacant for 5 years may be repurposed under original use rules, not substantial improvement rules. This has been a big issue to people who wanted to rehab vacant property, but if they had to follow the substantial improvement rather than the original use provisions, it would have been very expensive. And we will discuss that more in a moment. So let's talk about substantial improvement, because this is what has to be done to land and property that are not original use. Undeveloped land does not need to be substantially improved, but guidance warns against buying with the intent, and I quote here, not to improve the land by more than an insubstantial amount within 30 months of purchase. It does not need to be used in a trade, or it does need to be used in a trade or business. I'm like, wait, what am I saying? IRS is explicitly interested in preventing land banking. It literally says that, and they have said that out loud. And they've asked for comments on how to use anti-abuse provisions to prevent it. A 31-month safe harbor for development may be extended for delays beyond the Opportunity Zone business's control, such as government permitting delays. And multiple overlapping 31-month safe harbors are permitted for the same overall project. So, for example, one harbor may cover the underground work for a project while another covers the above ground work. And finally, a few other tidbits on real estate. Owning and managing real estate, rental real estate, qualifies as an operating trade or business for qualified Opportunity Zone business purposes. This is a big deal for people who wanted to know, could they do housing, including affordable or workforce housing, and would that qualify? Notably, triple net leases do not qualify as operating a trade or business as there's no active business involved. Finally, if a piece of property straddles an opportunity zone such that at least as much of the property is within the zone as outside of it, and the unit there is square footage, and the property outside is contiguous with the zone, then all of the property is deemed to be within an opportunity zone. So I want to turn back to our attorneys. The first set of guidelines raised about as many questions about developing real estate as they answered. I see everybody kind of looking at me and agreeing, yay. Does this second tranche, which in part changes the first set of guidelines, give investors clarity to move forward? I also would like you to address what we should expect in terms of anti-abuse provisions to come and what investments investors should avoid.
This is Dan. With regard to the first part of your question, whether my clients, for example, are ready to move forward, I think we need to go back and think about it's really all about managing risk. And what we see is what I see at least is I have some clients that were willing to move forward and go out and start raising money, for example, after the first round of regulations. Some wanted to wait until the second. So I think just from a broad perspective, it still comes down to the risk that the fund, for example, is willing to undertake. I do agree with you that we do have still questions, different ones now, but still questions. But yeah, I think it does come down to just the risk that you're willing to take on.
Well, the anti-abuse rules are, I'm anxious to see what they think is abusive. It's interesting. They say you don't need to substantially improve unimproved land, and then they say that you can't buy it with a view that you're not going to put more than an insubstantial amount of improvements on the land. So the question is, what does insubstantial mean? Because if substantial means 100%, then arguably anything less than 100% is insubstantial. So if I want to, if I buy land and I want to build soccer fields, children's soccer fields, you know, where I'm not going to put a significant amount of improvements, you know, have I failed this test? Or if I want to do a surface parking lot, have I failed this test? And in the preamble to the regs, they use an example of someone who buys an operating farmland, and you just continue to operate that. And they say that that is abusive because you're not increasing the economic activity on that parcel of land or the output of that parcel. So where they come down is going to be, you know, a lot of folks are anxious. Folks that do not have deals that are, you know, on the fairway, you know, so, you know, the parking lot, you know, that's a big parking lot operator. It's a huge business that they have. And if you, you know, can you do a surface parking lot? I mean, that's probably not within the intention of the program, but it is a legitimate trade or business. So we're anxious to see that. I think the bottom line here is folks were not happy with the 100% substantial improvement number. So they were trying to figure out a way that you don't have to put 100% in, you know, like with respect to buying land in a building, where you, when you do the computation on the 100%, you don't have to factor in the land. And so they're trying to find.
And I'm going to interrupt you just for a second for people who aren't familiar. This is a provision that says when you're substantially improving a property, you effectively have to spend what you spent acquiring the property on rehabbing it, which is a very difficult standard to meet. And the first tranche of guidance scaled that back to say you only had to spend the value of the structures, not the value of the land.
That's right, right. Because if you can't meet the original use requirement, you have to meet the substantial improvement requirement. And so if I buy land in a building, and this impacts folks on the east and the west coast, if I buy land in a building, land is so expensive, and if I'm going to do an ag rehab with the building, it's very unlikely I'm going to spend enough money to double the basis of the land. And so that's what brought that special rule in tranche. I'll call it the first tranche of regs. And then the second tranche of regs brought us the special rule with respect to unimproved land. And so we'll see where that comes out. And then the other thing, that triple net leasing is another big issue. And my conversations with Treasury, what they're very concerned about is they want some activity on the property. So a lot of folks have come to us and said, well, what if I just change it so that I pay, you know, instead of having the tenant pay for property taxes or insurance, I'll pay for that, the landlord. And I think Treasury's opinion on that is that's not enough, because you don't need to pay those property taxes and the insurance bill on the property, right? I mean, you don't have to be at the property to make that payment. So what we tell people is you need to have some type of maintenance obligation, because that is something that has to take place at the property.
I want to turn to our philanthropic leaders. These rules explicitly make rental housing a permitted activity and make it easier to treat vacant structures under the original use provisions, thereby lowering the threshold for redevelopment. How might these new rules affect social utility projects? Specifically, what types of projects are most likely to be affected and how? What types of social utility projects do you see underway, and what types of projects do you anticipate might get going now that the second tranche of guidance is out?
This is Suzanne Pfister from Vitalyst Health Foundation. We've been talking with nonprofits and healthcare organizations from around the state. And let me throw out a couple of examples that I think just conceptually. 28 of the 70 federally qualified health centers in Arizona are in opportunity zones. So we've been talking with federally qualified health centers, many in rural parts of the state that want to expand to provide additional healthcare services that could now do that or open a second or third site. So we've got interest already seeing that from the federally qualified health centers. The Maricopa Community College District, for example, 2 of its colleges, Scottsdale Community College, which butts up and incorporates, I think part of their land is on tribal land. They have a lot of Navajo residents or students that come down. They're looking at, in a perfect world, there would be dorms on Scottsdale campus. So we've talked to them about how would that, so the second tranche clearly allows for that imaginative opportunity. The Gateway Community College is also the second one that is in the opportunity zone. They, in a perfect world, would like to see dorms on Gateway Community College campus. So another organization. The idea of housing on city-owned land. So, or housing on, for example, the Maricopa Integrated Health Services, the county hospital has land that they could look at. So they're going back and looking at their land as to what's on opportunity zones. And from our perspective, the perfect mix would be a mixed use facility where there was some kind of healthcare, like a clinic or an urgent care or something on the first floor, with 3 or 4 floors above of mixed use housing, some affordable, going up to market rate. So you have multiple ways to pay for the equity return that is necessary. And that would still be both providing social utility in a healthcare standpoint, as well as in affordable housing.
Terry, did you want to add to that?
Sure. So this is Terry from LISC, and this is the LISC perspective on all this. It doesn't contradict what Suzanne just said, but the rental of real property clarification, for us, it just kind of memorialized what we were already thinking about. So it definitely clears the way for development on affordable housing and some of the community facilities that we've been talking about. The vacant property rule we think is a little onerous with the 5-year statement or guideline. So we will be going back and providing testimony about reducing that 5-year number. We really think it should be maybe a 2-year flat vacancy requirement. And then in regards to the other questions that you put forth, Shawn, we don't see that any of this new tranche is in any way opposing what we were already think is going to happen. We just still feel the issue is that the return on investment with the kind of development that we would like to see for the community doesn't compete with some of the investments that are in the 15 to 18% range. We're talking more 3 to 5% range. So we're looking for opportunity funds that would be willing to kind of take that or do a mixed use component where the return would be a little bit reduced. We are running a fund throughout the United States, and we're doing some workforce housing. So we have a fund that will tolerate the return of about 8%. And so we're finding that that really flows well with workforce housing. And that's some of the projects that we're looking at here in the Phoenix area. And then we are also looking at a couple of operating businesses. But the caveat for us to be interested in that and to use some of the resources of our investors is that they would have some kind of workforce development element to what they want to do. And they would pull from either the opportunity zone or a contiguous zone that is still low and moderate income.
Okay.
Wanted to add one major announcement that came out last week, which was HUD FHA has reduced fees for loans for housing, as well as they're looking to reduce timelines to apply for loans significantly, which is a big deal, whether you're, no matter where you sit in that. And I've heard that there's a mandate to find a way to make combining opportunity zone investing and low income housing tax credit, easier. And I don't know what that is going to turn into.
Yeah.
But maybe
Our only comment to that is that we're not sure how we get the takeout in 10 years on that kind of project. So it is something that I think everybody in the community development financial institution world is looking at, because we really want to take advantage of this huge investment in the communities that we work in. We haven't figured it out yet, though.
So it sounds like there's still more thinking to be done on that one. Okay.
Or I would say you've got to get creative. That's where the mixed use, I think, has the better. So we've been working with cities like, get your housing people out of the box of just talking low income housing. Get your community development, economic development out of the box of just talking commercial and industrial. Look at, think about workforce housing. So I think this really challenges some organizations to get outside of their silos and to really think about how do we take advantage of this in a multi-sector, interdisciplinary way. But I do believe with that kind of thinking, you can move this much farther along.
And there are projects that have been done like that here. Native American Connections right outside the window has a project that was financed by the income housing tax credits, but it has market rate units that are mixed throughout the project as well. So it's been done. It's probably not the norm by any stretch of the imagination, but there's examples that folks could follow.
Okay. I'm going to move us into some investor and funds related material. So some of what was in the The second tranche of guidance dealt with rules for investors. First of all, they told us that investments in opportunity funds cannot be services. They also told us that the IRC section 1231 gains, the 180-day opportunity fund investment clock begins on the last day of the taxable year. That's an important note for folks in that situation. They also noted that giving your opportunity fund shares to someone will create a tax event, but passing along your shares upon death through your estate will not. That's come up. We've gotten that question a number of times. We also saw some coverage about investment deadlines. This has been a concern really since even before the first tranche of guidance came out. Opportunity funds are meant to invest quickly, and the statute calls for funds to be assessed at the mid and end points of their tax years to verify that 90% of their assets are qualified opportunity zone property or business interests. The second tranche of guidance specifies that the testing should exclude investments received in the prior 6 months. Those assets must be held in cash, cash equivalent, or debt instruments of 18 months or less. So if you are a tax year, calendar year tax filer, that means they're going to come look at your books as of June 30th and December 31st, and they want to see that you're moving money out quickly. Well, the terrifying situation for you is if somebody walks in on June 28th with a large check and they want to invest it in your fund, and you're going to be assessed in 2 days. And what this did was assure you that you did not have to dump that cash into something in 2 days. Mm-hmm. There's more to it. It gets a little more interesting than that, but that was a relief for people who are trying to figure out how to manage the flow of money coming in with the flow of money going out. They also tackled the phrase substantially all. You may recall from our last webinar on this topic that the phrase substantially and substantially all is littered throughout this document in a way that's almost a little comical at times. So they began tackling that. So substantially all with regard to tangible property within the zone, it's 70%. Tangible property owned or leased that must be qualified opportunity zone property for the business to be a qualified opportunity zone business, 70%. Opportunity fund holding period for tangible property, qualified opportunity zone business property / interest in an opportunity zone partnership or stock, 90%. Holding period of a qualified opportunity zone business of tangible property as qualified opportunity zone business property, 90%. Okay, I'm going to hold off on the interim gains for now. So I was going to ask our fund sponsors to talk about this a little bit, because funds are under a lot of statutory pressure to move cash into investments quickly. The first and second tranche of guidance have given you some leeway to avoid tripping the 90% asset test, and more generally to take a bit more time making decisions and executing investments and development strategies. Is it enough? Will these latest rules affect how you pace your investments or plan your portfolio? Is there anything else you're still looking for in terms of guidance when it comes to fund operations?
Yes, for us in real estate, it is enough. I think, Shawn, you've pulled together a great group here around the table. I know here at Virtua, and I know at Caliber, our experience in development and construction is critical. So our pipeline, we've got 120 properties in our pipeline. Our team's done construction prior to the Opportunity Zone legislation, and a number, and I know the other teams, my concern is there are funds out there. New York Times estimated that there are 100 new Opportunity Zone funds. 60 of them, the number New York Times said, it never had a fund before. So that's frightening in this industry, right? Yeah. And then of the
especially
remaining,
a fund that's 10 to 20 times more complicated
exactly.
than a real estate fund.
Exactly. And so of that, the 20, the remaining, you need, the concern here is work with those sponsors who have the experience. Work with those as a fund. Work with those who have construction and development experience. Why? Because there's so many hurdles and hoops to jump over in order to be in compliance. The cardinal rule for Opportunity Zone, don't lose that property in your 10 years. Hold on to it. So you want to make sure that you work with someone who is efficient and has a strategy and the experience to complete the project, get it done on time, get it to stabilization. I know you were saying you're nagging the Treasury. Actually, on Wednesday, I'll be joining, I was invited to join Secretary of Treasury Mnuchin to speak about opportunity zones, the social impact of it, and so I'll definitely help nagging for you too. But I think a lot of us just wanting to make sure that this is successful, and definitely a word of buyer beware to our investors. Work with, and I know with Caliber and Virginia, we're committed, we've got the experience, pipeline, but just the commitment to our investors as well.
And I would add one thing, this is Suzanne. We've got very strong anchor nonprofit institutions that know how to build affordable housing in Arizona. We're lucky in that regard. Is that we laugh when we've got a nonprofit developer that have real estate people. We've got a level of sophistication in Arizona that is extraordinary. So they know how to build multi-use with behavioral health combined with low income and affordable housing. So the good news is, in addition to having savvy investors, we've got savvy nonprofit developers as well, and people who know how to build that social utility, those products.
And Shawn, if I could just add to this, because this is critical, but Virtua and Chicano por la Causa, who has 50 years experience, we are partnered. And we believe that this legislation, that partnership allows us to effectively give back to the community. So our projects are entry-level housing, workforce housing, affordable housing, and by layering the different programs and working hand in hand to be able to provide the housing, but also provide all the child care, the health services, the credit education. This is it really, I was letting Senator Scott know that this legislation was transformational, I think pretty genius in that it brought all of us here to this table. We wouldn't be all here at this table was it not for the way that the Opportunity Zones has set the plate for us all to be here, to bring what we bring, investors, a decent return, nonprofits, to find a solution to what you've posed here.
I think I echo everything Quinn said and add another layer of perspective for the investor world. So, you know, the investors are a little bit, the folks who are actually going to write the checks to go into the fund are a little bit in a tough spot. And we see that because we're talking to them directly all the time, because their advisors, the people they work with, their CPAs, their financial advisors, et cetera, are still trying to figure this out. Their lawyers are still trying to figure this out. Everybody's still trying to figure this out, and they have 10 days left to get invested before their 180-day rule comes up or whatever. So just to speaking, you know, channeling directly to the investors and getting past all the people that are hopefully supporting them, but oftentimes not able to give them answers. You've got to understand that in terms of real estate investing, there's nothing, you know, we know what to do. We have good projects. As Quinn mentioned, Calvert's got $75 million worth of project value in our fund currently. We've got another $250 million worth of projects that we can acquire that we have in contract right now. So there's plenty of good projects. There's plenty of good places for your money to go invest into. But you definitely need, as Quinn mentioned, to work with people who actually know what they're doing in the world of development and construction.
But does this change for you? You know, anything that you're going to do with planning your timing or your portfolio?
For us, it was almost unfortunate because it took away one of our competitive advantages. We've spent our entire 10-year career raising money and deploying it at the same time. So we had an advantage that, you know, it was very difficult to do this. I think it's kind of taking away from that a little bit, but it's not going to change our plans.
I mean, I think for new funds, this is really important because if you set up if you take money in June, you know, June is you get 6 months, right? And even if you take money on the last day of June, the whole month of June counts towards that 6 months. So that means by November 30th, you have a testing date. And what this does is it says that you get to go back 6 months in any cash, because cash is a bad asset under this program. And so any cash does not get factored in that 90% computation. But if you take money in June, you have your testing date on November 30th, but your second testing date is December 31st. And that date, you have to take into account the cash you've got in June. So you have to deploy that. But if you take money in July, you can almost go all the way to June 30th before you have to take into account the money in July. So if you're setting up a new fund, you want to hold off taking cash in June. You can take it in July.
Can I ask some other nitty-gritty questions of our attorneys? And that's, can you talk about the specifics related to rules for investors, particularly with regard to 1231 gains and 704D losses?
Sure. So this is Dan. I can try to tackle this without going too deep. Basically, and you covered this in a previous slide, Shawn, but 1231 gains, the the after netting the losses and gains. Thank you. That's great. There was a question of when that testing date occurred, when the realization date occurred for the gains. Essentially, the regulations, the second tranche clarified that really the only date that it makes sense is the last day of the year. So it for an investor that has 1231 gains, your 180-day period starts on that last day of the taxable year.
We can probably skip the 704 losses and move on. Did you want to add anything to
Well, I mean, Treasury thought that they were giving us, a lot of people are upset about this rule because they're saying, listen, I incur 1231 gain now, I want to invest now, and I got to wait now until December 31st. But Treasury thought that they were giving us they were actually giving us a favorable rule because from Treasury's standpoint, they were saying this is a net. So you have in order to have a 1231 gain for this purpose, you have to net out the losses. You don't know those losses until the end of the year. So what we're going to do is we're going to ask Treasury to still give us the 180 days from the day of the sale and say, listen, the onus is on the investor. If the investor incurs a 1231 gain, which is a sale of real property that you've been using in a trade or business for more than a year, would be a 1231 gain. And so our argument is, listen, it's the investor's risk. If they make a sale of this apartment building, invest within 180 days, and then find out they have a loss that wipes out that gain, then they've over contributed to the fund, and that investment won't get all the tax benefits.
All right. Well, our next fascinating topic is interim gains. And you can see the looks, everybody around the table, I wish you all could see this because it's all this sort of pinched grin laugh. How to treat interim gains is a vexing issue. And the second tranche of guidance clarified that opportunity funds have 12 months to reinvest interim gains without the proceeds being counted as a bad asset under the 90% test. So we've got a parameter there. The fund's gain gets allocated to the investors if the fund is not a corporation and is taxable as income for investors. If the fund is a corporation, the corporation pays the tax. Treasury says it does not think it has the authority to treat these gains differently. So first of all, before we even get into the hypotheticals, this is a big issue. And to make it easier to understand, I'm going to want to walk through some scenarios with you guys tackling that. But I want to stop for just a moment, and I hadn't planned this, but I want to ask our fund folks, how does 12 months work for reinvestment for you?
That's actually pretty reasonable for the real estate world.
Okay.
That's super reasonable. For a business, it takes a long time to identify your next venture. Sometimes it's right on your doorstep. So from a real estate perspective, in my chair, that's really reasonable.
And for us, because you have the pipeline
Yeah.
and you have the projects and you've been working on these projects, that's what makes a difference.
All right. The complexity of this is such that I thought it would be interesting to try to tackle it through a series of hypothetical analyses. So I'm going to start with our attorneys, and I'm going to read a hypothetical analysis. Maria realizes $100 of capital gain in 2019 and invests it in a multi-asset opportunity fund that's structured as a partnership within her 180-day window. So she has checked the boxes of doing the right things at the start. The fund in turn invests $10 of Maria's money, along with other people's money from their fund, into original issue stock in Company X, a qualified opportunity zone business. The opportunity fund takes a minority position in the company, and the investment is made in 2019. In 2022, Company X is sold to a third party, and the fund sells its stock to the buyer, earning a return of 3x on its investment. Here comes the fund. What is Maria's tax liability as a result of the sale of Company X? What happens if the fund reinvests all of the gains into qualified opportunity zone businesses within 12 months? What happens if the fund allocates this gain to her and others? Does it matter whether she reinvests the gain into another opportunity fund? How do these various decisions affect Maria's 5, 7, and 10-year clocks? Okay, attorneys, what's going to happen to Maria?
It's a partnership, QOF. Yeah.
It's a partnership, yep.
Yeah. So that means that would be a $20 gain, right? 3x.
Yes.
And so that gain would be allocated to her. So she would pay tax on the long-term capital gains rate.
And I think we should probably point out that would be regardless of whether the fund returned the capital to here
That's right.
or whether it
Yeah.
invested the money. So she's got to be prepared to pay that tax.
Correct. And what folks are hoping is that Treasury, if the fund reinvested within 12 months, the Treasury would say that taxable allocation, she would not have to pay tax on that. But Treasury felt like they didn't have the regulatory authority for this. And if you look at the Blue Book, which is the legislative history, they specifically say in the legislative history that they thought that those sales within the Opportunity Fund would be taxable. So in order to fix this, you have to rescore the provision. And so Treasury looked at this and said, what we're going to do is we're going to give you the fund would be holding cash for that year, and you cross over one of the testing dates and probably find yourself in penalty situation. And so
Because you don't have 90% of your capital invested.
Correct. We have too much cash. Yeah. And so what Treasury did is they said, we're going to give you a break on the penalty. So if you reinvest within 12 months, that cash is treated as what we call opportunity zone property during that testing date. But she still has a tax liability that needs to be paid. So they didn't give us everything we wanted, but the 12-month reinvestment is very helpful. 12 months is enough time. We have that in new markets, and it's enough time to find another investment.
This is Virtua. I would just point out that two things. One, this isn't a horrible problem to have. Gains mean you're making money. What's the real problem? The problem is what happens if you're dealing with a sponsor that doesn't provide for distribution and just churns to churn.
Yeah.
And so this is kind of, the regulations help. It still matters to pick which fund you're investing in, because who the sponsor is will matter when it comes to things like the tax distributions.
Now, it is a gain that you can, it does trigger a gain that would qualify, and you could invest in another fund, in an opportunity fund, and defer that tax, but you still have a day of reckoning, right? December 31st, 2026. So you could do that and reinvest. Now, unless they make a distribution to her, she doesn't have the cash to go reinvest. You'd have to find it from another source.
And to that extent, the rules on debt distributions helped us immensely, because if we are going to sell something off that's large and we want to do some form of distribution, being able to do a debt distribution or an equity distribution, depending on what the situation is in the fund at the time, is helpful.
Now, what does this do? I'm sorry, David, do you want to?
I was just going to add, I was going to answer your last question up there.
That's about what I was about to ask.
Great,
so perfect
great.
timing.
Well, as Marc mentioned, Maria could reinvest that assuming she had the cash or it was distributed into another opportunity fund. This is in 2022, so she'd defer until 2026, assuming she held on to that. She wouldn't receive the benefit of the 5 or the 7 year step-ups in basis due to the fact that she can't hold that position in the new fund for 5 or 7 years. She would, however, receive the benefit of the 10-year, the big kahuna, so to speak, as long as she held that for 10 years on the game.
Scenario 2. Everything is the same, only the sale of Company X takes place in 2028 instead of 2022. Can the fund still reinvest the interim gain? If the fund allocates her gain on Company X in 2028 to Maria, can Maria roll her gain into a new opportunity fund investment? And again, how do these various outcomes affect her 5, 7, and 10-year clocks?
Well, in that year, in 2028, that's past 2026, so she could not roll that into a new fund. But, a lot of people are very upset about this interim gains rule that we didn't get everything that we asked for. The bottom line here is it's still possible for the fund to make a distribution to her so that she could pay her taxes. And, so in that case, if she's got 20 of gain, her tax is $4, right? 20% of that at the federal level, right? So the fund could make a distribution to her so she could pay her taxes. And then the fund could reinvest everything else in a new asset so that the fund is not hit with a penalty. So that's what we're advising clients to do right now. So.
Oh, okay.
think one thing that gets a little lost on the reinvestment thing, to your point, is well, we just made a big gain theoretically, and when we reinvest that gain, we now are making money on our money, right? And so perhaps it causes an interim tax effect to the investor, but the potential upside of the ultimate tax benefit that they receive when the value of their share has gone up 4 times or 5 times instead of 2 times over 10 years might be offsetting to that significantly. So you don't know what's going to happen in investing, but being able to take a win and then reinvest that gain typically produces a compounding effect. It's just how our world works.
Okay. So, still to come. We are not done with guidance. First of all, we don't have any final rulings yet. And second of all, we're expecting at least one more tranche. We expect that we will see rules for interim gains at the fund level, specifically whether funds should be subject to tax. And if I were a betting woman, I would say that hearing they're going to hear in July on this second tranche is going to have a lot to say about interim gains. So we may see some additional clarity or changes in tranche 3. Is that fair to say?
Yeah, I mean, it's an issue, but Treasury's saying that we can't do anything about it.
We also will have some information on reporting requirements, specifically what information Treasury should collect on opportunity funds and their investments. Tax form. Treasury is seeking input on that reporting, and Senators Booker and Scott have introduced a bill regarding reporting. We're also expecting that we'll see some anti-abuse rules in the third tranche of guidance. So again, I'll start with our attorneys. There's a lot of interest in the reporting requirements and anti-abuse provisions that are likely to be in the next round of proposed regulations. What should we be expecting?
So I think a couple of the big things that I'd expect are fund decertification provisions. So if a fund, the type of conduct that would lead to a fund being decertified in the process of that occurring, what does that mean for its assets and its investors? We need some clarity on. I think this isn't in the next potential tranche, but the bill that was just introduced is an interesting one. It sets forth some initial. I mean, I don't think they necessarily drill down as far as I'd like them to drill down on social impact, but some initial potential reporting requirements for funds is something interesting that came out.
Yeah, I mean, one thing to note is that I've kind of heard rumblings that there's a good chance that we're going to see a bill that's going to move the 15% reduction instead of it being December 31st of this year. We're going to try to move it, get us another year, because it's taken so long to get out these rules, which, in my opinion, is not as long. I mean, we have stuff that was codified in the 90s that we still don't have rules on. So I don't think it's that long, but people are upset that it, in their mind, it's taken over a year.
Well, it's tricky when you put these kinds of time restrictions.
Very tricky, yeah.
Especially the investment side.
That's right. So, but yeah, the anti-abuse rules, that's what we're looking at the next tranche. It'd be great to have, it would be great to have some safe harbors so your transaction is not going to fall within the anti-abuse rules, because those anti-abuse rules seem to be pretty subjective.
I would love to see an anti-abuse rule that says marijuana deals are not going to work, because then I could stop getting an email from a marijuana deal person every other day. That would be wonderful.
So I turn to our philanthropic leaders. Treasury has asked for input regarding what information should be collected about opportunity funds and their investments. What would you like IRS to collect, and what would you like to be made public?
So I have a whole list. This is Terry with LISC, and it is what we'll submit to Treasury. So we're looking at some data points. So the dollar amount of the investment, the total project cost, the NAICS code for businesses, the census tract, of course, of the business, the total square feet of the project, the number of full-time employees at the business, the number of quality jobs for low-income persons, the number of low-income persons that were served, the number of housing units with the percentage of affordable to low and moderate income persons that are being served. And in addition, we would recommend that the qualified opportunity funds be required to provide a brief narrative description of each project investment, which would include the nature of the project, the benefit to the community or the community-based organization, the degree to which the project was developed in consultation with the community residents and are mitigated against displacement, the extent to which the project contains or connects with local workforce development efforts for low and moderate income residents, and the extent to which the project could not have moved forward without opportunity zone fund incentives.
And nationally, this is Suzanne, nationally, the philanthropic community has been working on this kind of framework of what they would like to see. Kresge has led the way from the Kresge Foundation, but there's a good model if someone wanted, we can put this resource. The U.S. Impact Investing Alliance has developed a reporting framework that stresses the principles that Terry talked about of community engagement, equitable community benefits. So there is a draft framework that's being circulated around the, because these national foundations are putting their money where their mouth is and developing their own opportunity zones. I would say one other thing, that ultimately this is a zoning issue. When all it comes down to, it's still city or county governments or tribal governments that are going to approve the zoning. And so I think our elected officials and the zoning process still has some influence here. We've developed a book called, or a workbook called Pre-Community Engagement, how to do this, how to ask and solicit community voice. And I think that will be important. And what I would hope is that cities, towns, tribal leaders ask those kinds of questions when it comes up for a zoning. Have you engaged the community? Have you looked at what community need is? Are you creating displacement and gentrification? Because the city will have some zoning, a city, county, tribal will have zoning influence. And so we've been meeting with cities and other entities talking about the importance of that. So I think in addition to the IRS, local governments who have that ultimate zoning approval are asking those questions and requiring that as well.
Shawn, may I add something?
Yeah, I was about to throw this out to our fund sponsors and say, so what are you guys thinking about this?
I love that this has become the topic of conversation. Actually, my meeting lunch with Secretary Mnuchin and Senator Scott on Wednesday is specific to social impact, because this is so close to our heart. At Virtua, we've partnered with Chicano por la Causa on make sure that there's a full scope, and with across the country but also with ASU on fine-tuning our measurement. We've already implemented a measurement on social impact within our own projects. We measure, so we have residential and hospitality, and on our hospitality side, we measure number of jobs, but also quality of jobs. And what does that mean? What is the salary? And we also want to make sure what is the opportunity for an individual to move into the middle class? What is their growth potential? In our hotels across the country, we have so many individuals who come in at the front desk and housekeeping. And our retention rate, our hotel division has been around for 30 years. And we've been able to have a 71% retention rate. The retention rate in hospitality is 24%. Our key executives at our management executive levels have been with us for 18, 20 years. So we'd like to just say, let's look at jobs, but not so it can't be a dead end job. We need a job that if people, it's not a handout, it's a hand up. And if we can give people training and education so that they're allowed to move up, we need to measure that. So that includes salary, the quality of job, and a path to the middle class. On our housing side, what we're measuring is we focus on entry level. Luxury homes are beautiful and I like to see them. I like to be in them, but the social impact component of them is not as strong. So we focus on entry level, but also to count number of units for workforce housing, number of units for affordable housing, but also replacement. It's kind of the Hippocratic oath, Gentrification is a real problem and it can be solved with the work of both cities and local municipalities and investors to replace what we displace. So, we work closely, as you said, Suzanne, really well, that we all have to work together and to work, not trying to force a square peg into a round hole. But I know at Virtua, we say, we work with cities and we replace the units that get displaced, averaging between 10 to 25% of those in our projects to make sure those are for the individuals in those communities. So that's the metric that we're presenting. And we are open. We think open transparency. It helps us all This is an industry, as you've seen here, just forming and building in those metrics is critically important. In 10 years, we want to look back and say, you know, the spirit of this legislation has come to fruition, that we actually impacted the communities that we wanted to.
Let me ask Caliber.
Yeah. So this has been kind of a fun journey for us, because when we first got into this, I think I asked Terry, I was like, so what do you do? And she's like, you don't know what I do. Like, you know, and it's true, because we were in our silo, as you guys put it, doing our thing. And so what we did on the impact side is that we've taken a look at the impact investing world in terms of how to incorporate that into what we do. We wrote an impact thesis into our private placement that said, this is our intent. We want to start measuring some things. We don't know what things we want to measure yet. We've worked with like the University of Utah's Impact Investing Center and a group called Medora and a couple others that are trying to say, this is how you calculate an impact rate of return. Because ultimately, you know, we're a fiduciary to investors. This is an economic development program. We're there to make them the most possible money we can. That's our job, right? But part of doing that is also creating the most possible impact value or impact rate of return. And we can do that through tracking and also through looking at different unique opportunities. One of our programs one of our projects we have, we're looking to support a music festival. Well, it doesn't necessarily create an ROI for us on the investment side, but it does create 20,000 artistic impressions a year, which is kind of valuable to the community. So we're learning about this stuff. We're learning how to track. It's not a requirement in the law, and ultimately it's our job to make our investors a profit. But I'm a firm believer that most investors want their money to matter, and they want their investments to matter. And so by being able to show them the profit, the safety, and the impact, I think that's going to be a winning formula for us. And then, of course, just like you, we want the program to continue. And if we can show the value that we're creating, we can show the value, the impact on the communities, and we can show different statistics beyond job growth, I think that will be a case to continue the program.
I want to throw a question out to our attorneys, because both of you run larger multi-asset funds, but we know that it's entirely possible for a small group to do a single asset fund and operate an opportunity fund just like that. How do you need different reporting rules for large multi-asset funds than you do for smaller ones that are doing one-offs? Or is it possible the ones doing one-offs will be sophisticated enough to do the same reporting? Should it be the same? What do you guys think? And then I want to ask Terry too, since you're going to be submitting the testimony to Treasury.
I mean, I think this is a big issue, right? Because if you want Congress to make any changes to this law, the first question that's going to be asked is this working, right? Is it working as intended? So we absolutely need reporting requirements, and I don't think that it's that onerous for a single asset fund to have these reporting requirements. I mean, they know the project. In fact, most of the time that it's vertically integrated. So they're actually controlling the opportunity zone business. So they have access to all that data. So should not be a big deal.
It should be the converse, right? We have both single asset and multi-asset funds. Fewer the assets you have to report on, the less of a reporting burden it ought to be.
I think actually the opposite. So I'm coming from my chair, being a multi-asset fund and $500 million fund, and we're doing a large offering. And you know, in order for us to do the complex deals that many of the people in this room want us to do, we need to be able to represent a pool of capital and spend a significant amount of time with community leaders, city leaders, et cetera, to be able to do that. And if we have to compete against single asset funds that have significantly less requirements, that are much easier to stand up and do, I mean, you know, that's the conversations in the hallways after these types of meetings is usually with somebody, hey, I just sold something, I got a lot of money, how can I use this thing to make some money for myself? And it's usually in a single asset fund and a single deal that's going to go below the radar. So I thought the intent of this law was to have a fund manager in place to avoid abuse, and that's why we're here. So I think the level of complexity is already pretty high, but it's not that high, it's not that hard. You just have to do good business, not do deals that are on the edge or not in the fairway, as Marc mentioned, and have good counsel.
So you think same rules for everybody, Terry?
I do, only because it's the same rules that we've played by for 40 years. We invest $1 billion a year in these communities. And we have investors that come to us with a $500,000 investment that have all of the criteria that I just mentioned on top of, geography restrictions where their money needs to count. And we have folks that, we have a $500 million fund in the Bay Area that we manage, and we have all of these requirements too. So, I do think that for the outcome of this legislation to be what it's intended, that this kind of reporting requirements need to be for everyone.
Quannah, can you talk to us a bit about what's the conversation over in your community about what sort of projects you want, and what do you want to know about them, and what you're pursuing?
So our focus, the community's focus, is going to remain on high quality development in our commercial corridor. We have entertainment, retail, office, hospitality going on. We do think we're going to see more light industrial uses, which is something that's a little bit in the community, but I think it will expand. And for us, we're looking at tax generating developments that offer economic opportunities, employment opportunities for community members.
Now, I know that the Salt River Pima-Maricopa Indian community was a leader on the lease issue corresponding to Treasury. I'm wondering, are you guys in conversation with any other tribal communities? Are you hearing anything from them about their concerns or their intent?
So I do want to make sure that we thank Marc for all of his work and his help in helping us advocate for the position that we wanted and for the second tranche. We have had some informal conversations with other tribes in Arizona. I think they're all still, in the conversations we've had, people are still trying to figure out how this can impact tribes. I think for the tribes that we're speaking to, the lease issue, the ability to put a lease in place is still a challenge in an expedited time frame. And then there are tribal, regional, national organizations, NAFOA, that are all analyzing this and also giving advice. So I think that that's a resource that we are certainly looking at, as well as the tribes looking at this.
I do want to remind the folks listening that if you have a question, please go ahead and submit it, because in a not too much longer, we're going to turn over to your questions. So please go ahead and get those in so that we have them. I do want to ask our fund sponsors. We've all been waiting for this second tranche of guidance for a long time. Now that it's here, what should we be expecting from you and your fellow fund sponsors? Should we expect a rush of projects, a change in the type of projects, anything new or different or not?
I think it's help me help you to the investor community, for us, because we're raising money pretty quickly. But having said that, we got a lot of money to raise. We got a lot of projects in front of us. We have a pretty tight window where you're going to get the best economic return on your investment from a tax perspective, which is pretty much the end of this year, and then it starts to go down after that. And unfortunately, I know I've spoken to, I'm not sure if Quinn has, but I'm sure you probably have spoken to just about every major institution on the planet. And all of them are taking a very much yeah, sure, maybe we're going to make an investment. We'll pick one fund and see how it works out. It's kind of a slow, lackadaisical approach to this. So will you see a rush of projects? Probably only if the big wealth management complexes, across the country actually start to adopt this product and take on a couple different funds, because they're allocating $25, $50, $100 million per investment into a fund. And otherwise, we're just raising money, from investors and investment advisors and family offices and those types of people. So until you see the big institutions adopt, you're going to see a handful of funds that will raise some money and a bunch of little one-off projects here and there. But if you want to see the $100 billion that was promised this year in investment, you've got to see the investment come into the funds.
Similar, we've actually, kind of listening, not so much the regs, but more our investors, our family offices, our ultra high net worth, our institutions, and groups that have been working with us over the years. A lot of the feedback has been more, this matters to us, the social impact matters to us. How can we give back to the community and still get a decent return? The execution, I think, has become a key part. So the projects that we build, you know, our hotels, we're the Marriott Hilton franchisee. I know in some circles we're considered Marriott's hotel manager because of our relationship there. So sometimes design on our buildings, because if you're doing a one-off, and I joke if I say, if you're building these 70-story luxury off a cliff in California, it's going to take you're not going to make that 30-month requirement, right? That 30. And so we say design is critical. Our Marriotts, there's 1,000 of them built across the country. We literally know down to the number of nails. So we're able to get that built in 12 months and 90 days, get that cash, you know, stabilized. And so execution is critical. The locations, making sure there's no acts of God, weather delays, labor, material shortages, and really mitigating our risks for investors. That is really more of a drive and just what we're hearing from our investors than some of the things here, because the real estate component has been, for the most part, those questions have been answered and addressed.
I would just say though that the first set of regulations basically made clear that if you stuck within the four corners of the statute, you were good to go. And that meant you could do raw land deals that you intended to substantially improve. Second set of regulations actually opens up the playing field. You now have ground lease developments with the clarification on original use. You have the possibility of buying deals in construction. So I don't know that it is a, you know, it changes the game, but it certainly makes more projects tenable now than were tenable before. We're already looking at deals on municipal land, deals involving ground leases, deals in construction that with the first set of regulations would have been too iffy to go forward.
I think it added one more thing to that, which was the first year of being on panels and expert panels all over the country was do single asset funds, because that's what you can do based on what the law says. But as a real estate developer and in our shoes, what does it take to build the types of relationships to do really great projects? It takes the ability to represent more than, I think I can raise the money to do this deal. It requires you to actually have a fund and have infrastructure and all the other things that we have. So this tranche of regs actually proved out multi-asset fund, a large fund, a multi, strategy approach is something that you can do, and now is something that, in my opinion, is the most favored status.
I say the other thing too is it made possible a clear exit strategy. Before the question mark was, how do you get out of this? Are you going to have to sell your interest in the fund? And if you're going to do that, what's the market for that going to be? With the second set of regulations, it's clear you can exit out as the fund exits out deal by deal. And that ought to make, you have a lot of different factors going into play, among other things, whether or not some of the statutory deadlines are going to be extended, but having a clear exit strategy should make it a lot more viable of a investment for people who literally before were wondering, how do I get out of this thing?
Yeah, this is Brion at Caliber. And I think the most significant thing that's coming out of the second tranche is people now understand how to invest into operating businesses. So when we were at this Skybridge Alternative Investment Conference in Las Vegas last week, we were talking to some very passionate, very successful entrepreneurs who own and operate co-working spaces. And they intentionally are looking to locate their expansion into opportunity zones so they then know that their tenants will be eligible for the opportunity zone funds being established by the VCs and the private equity groups. So I think that was a very exciting component of the second tranche.
Okay, one more question for everybody before we open it up to questions from the audience, and that's, we covered a lot of ground here. Is there anything we left out that you think we should address before opening it up to questions from the audience?
I think it's important that folks know that you can refinance after 2 years and excuse me, and not cause a problem. So you can put debt. You can't do it. Like if I've got a $5 million gain, right, and I put $5 million into the fund, folks are like, okay, you could just take out a $4 million loan and then distribute out that $4 million right away. And Treasury looked at that and said, no, we think that's abusive. But after 2 years, you can do that. So you couldn't do that the next day, but you could do it after 2 years.
So you're saying a fund can do that to
Bring cash back
Liquidity.
to the investor. Yeah. I think the only thing I would add to all the economic developers out there and folks, developers with deals and that kind of stuff is, I mean, as you can imagine, we're getting inundated with project opportunities. Keep sending them; they're great. Part of being able to raise significant capital is being able to show you have a significant pipeline of deals. So, sometimes it might take a little bit of time, but don't give up. I think keep bringing your deals to funds.
And
showing
put them on
to us.
the Arizona Opportunity Zones network.
Absolutely. That was the
people
next
can
thing
see
I was
it.
going to say. That was the next thing I was going to say. But it is very helpful to get that deal flow, because we're now, I was in a call with Deutsche Bank and Abbott Downing, Wells Fargo, and all these other people, and they all want to know, do you have projects or do you not? So that's very helpful.
Yeah, this is Brion with Caliber. And the one thing I'd like to point out, especially to people that are in rural areas, if you're trying to figure out how do I create more employment opportunities in my city, in my opportunity zones, they really need to be engaging with the local business owners and understanding if we have an old vacant factory, what type of business can we bring in that's going to have an impact on the community that will also incorporate that job creation component. So I think a lot of the interest is being seen in the large cities, but we need to make sure that this is impactful for the rural areas as well, and engaging in those conversations with the business and community leaders in those towns is crucial.
Terry, Suzanne, what are we not talking about that we should be talking about?
Well, we're hearing from community members that they're afraid of getting dumped on and that they will get displaced. And so I think it's important to also try and work with engaging, and we've talked about in certain communities, really neighborhoods, developing a people's prospectus, if you will. So, and I'll give you an example, all along the light rail in the city of Phoenix, there's been a lot of work done engaging communities about what do you want to see there. There's health and safety plans. There's community engagement that was done through Reinvent Phoenix along the Phoenix portion. So that community engagement in some of these places has already been done. And so finding that material, which is easy to access, and working with those community groups, I think inoculates you, if you will. There's a lot of opportunity zone land right around 19th Avenue and Camelback, for example. And Catholic Charities is working in that space, for example. They're looking at that, and there's community engagement in that area. So we're trying to help say, how do you create kind of those people's prospectuses, which in the long run solves or mitigates some of the zoning challenges you think you're going to have, or you could have, if what you're proposing is not what the community wants. And so doing that ahead of time really can smooth the way, just as you're working with investors to smooth the way, working with that community in those areas where there's some clear, getting that community input. I know Globe and Superior, for example, have been looking at how do we leverage what we have as a community to bring in that mix of housing and industrial and commercial. So what's missing is that community voice. And I would just say you want to inoculate, you want to engage them and create it so that you don't have zoning problems that only delay what is a short window to turn dirt. So doing that upfront work, it can make it much, much easier in the long run.
Okay. Dan, did you want to add anything?
Sure. Yeah, absolutely. Just to add on to Suzanne's point, I think that we've seen, at least I know all of us at this table have seen stuff from across the country. Municipalities, cities, states pushing through paired legislation or local incentives to both help attract capital to their localities, but also spread the word, so to speak, about the program. The public is often the least to know about this, the last to know, about this process. So I think we need to continue to work to educate. For the cities and towns and municipalities that are on the call, I would encourage, I've spoken to a lot of you, but encourage you to keep working to the extent you can, expedite entitlements, work through zoning issues, make it so projects are likely to be sourced in your locality. I think that we can invest across the country, and to focus on Arizona and specific communities within Arizona. Towns and cities should continue to work to make themselves known that they're ready, willing, and able to push through projects when they're ready to turn dirt.
I will say we have on the Arizona Commerce Authority site a guide for rural economic developers. And I mean, honestly, any economic developer can look at it, but it's really about how to be prepared with the zoning and the entitlements and really the environmental studies, any of that stuff that you have to be really prepared, particularly around your best sites, and to understand what your utility situation is. We're also encouraging them to talk to their big local investors, because what I'm told, and our funds can correct me if I'm wrong, is that outside money likes to see inside money. And they're nodding, so that's good. The other thing I wanted to ask, because it didn't come up and I'm a little surprised by that, is the philanthropic community is sitting a little bit on the sidelines with some money at the possibility of getting engaged in deals that they want to see done.
So you've got national funds that have already, like Kresge, that have already engaged. I think you've got local funds that are looking at, in our own impact investing, how do we take advantage of that? So my board, for example, this is Suzanne from Vitalyst, is looking at, are there opportunity funds that we could diversify our portfolio to invest in? So they're clearly looking at it, but again, trying to figure out where does it fit within the portfolio. We don't get a tax advantage as nonprofits and philanthropic, so it's a different, we're not looking to save money or shelter capital gains. So it's a very different, but we are looking to do social impact investing.
Quannah, is there anything that you'd like to add before we open to, not to put you on the spot, but I just wanted to offer the opportunity before we open it up to the outside questions.
I think that I would just emphasize that certainly I'm really familiar with the tribes in Arizona. I think there are lots of opportunities. I think that sometimes doing development in Indian communities seems like a mystery. It seems very labor intensive or very challenging. I just want to kind of dispel those myths to the extent that I can. You know, the Salt River, we have put a lot of investment in expediting and streamlining our processes. We have I have 10 people on my team alone. We have our own in-house, staff for zoning, for environmental protection. So Salt River isn't the only tribe who's made that investment, but we certainly are here. We're ready, willing, and able to move forward on projects. And so I would just say, if anyone has questions, please feel free to contact me or other tribes in the Valley. And there's a level of sophistication there that really kind of shows tribes' investment in this type of development.
Okay. Well, thank you. One thing I want to just show is I did not make all this up. The summary draws heavily on a couple of pieces from Michael Novogradic and the Economic Innovation Group, and help I got from Marc to correct some of my errors before we went live. So I appreciate that. I also want to mention some other sources. You'll see them here. We have an Opportunity Zones page on the ACA website. This also has links to the Treasury's second tranche press release, the actual text of the guidance if you really want to read all 169 pages of it for yourself. And also the request for information about Opportunity Fund reporting. And also at the time that they put out the Opportunity Zone and Fund second tranche guidance, they also put out a list of actions that federal agencies are taking to support opportunity zones, including the stuff that Chris mentioned that HUD is doing. So you may want to take a look at that. Again, I will remind you that this recording and this material will be available later. But at this point, we're going to turn to some questions that we have from the outside. Now, I got 2 eager beavers who emailed me even before we started to let me know. And I think one of them we mostly covered, but not entirely. So I'm going to read this one out and let me know if you would like to take it. This has a lawyerly feel to it, though. After the most recent guidance, it appears that an Opportunity Zone fund can sell an asset prior to the 10-year holding period. If sold, with the proceeds remaining in the fund, capital gains are not realized by the investor if the proceeds are invested back into an Opportunity Zone investment within 12 months. First, is that correct? I think we've noted
Well, isn't that
that
their
it's
interim gains? I mean,
right.
They're going to get allocated the gain.
So I'm sorry, but no, the investor will be hit. So if the real question is, does the time period reset for an additional 10 years on the new Opportunity Zone investment, or does the 10-year period remain the same as the original Opportunity Zone fund investment?
Within the fund?
I think what's happening is this person is conflating the investor's investment investment in the fund and the fund's investment in the individual.
Yeah, I mean, the regs, the regs did not give us the answer of, on that 12-month reinvestment, if the fund goes and reinvests in another qualifying asset. But my opinion on that is that it does not reset. So you would keep, because that's, that 10-year is at the investor level.
Mm-hmm.
And so it should not reset if you keep it within the fund.
I agree with Mark there, and I think the second what the question also may have been asking was something we covered in one of our scenarios, was if the allocated gain can then be reinvested into another fund if that starts another 10-year period, and the answer is yes for that.
This is a simpler one. This one is, have there been any changes to the self-certification process?
We're going to see a new form or changes to the form probably within a few weeks to take into account some of the changes in the regs.
Okay, here are the questions that have come in since we began earlier today. First, I have properties I own purchased by 1031. If I sell and reinvest, will it wipe out existing deferred tax?
I mean, they have already traded into new property and they want to sell the new property.
I think they're saying I've been 1031ing and I've got this big gain that I continue to defer. Yeah. If I do this, will I be, and my answer to you is subject to the fact that we invest correctly, that we get a significant, investment gain, reasonable market gain, that we go the full 10 years. What we will earn you in terms of the tax benefit that comes out of the Opportunity Zone program will effectively pay about 2 to 3 times your original tax bill if you do it right. If you do all the math, that's how it all kind of boils down. So no, you will eventually pay the tax bill that you owe on that deferred capital gain in year 7. I think it's April 2027 or whenever it is that you have to pay the tax. But because of the benefits you're gaining from getting into the Opportunity Zone program, you're getting so much additional gain on your investment that you would not normally get. That is effectively paying your original tax plus giving you a little bit more beyond that. And so a good way to look at it as an investor is, this is a way for me to get out of the constantly rolling 1031 thing, where I have to roll my 1031 to the next one, and I can never get access to my capital until I die. This actually gives you an exit that's like sort of like a reasonable off-ramp to that. I know that's very high level and anecdotal, but I think it's also right.
Okay. Would a 30 years lease for development qualify as an Opportunity Zone investment?
If it's 30-year lease,
It's on market terms.
If it's on market terms, okay. We're getting some questions about GIPLETs, government property lease excise tax. How does this work? I'm going to read 2 of them because they're similar. How does this work with a GIPLET where property is leased, but the rate is a property tax abatement and not necessarily a market rate? And would investment by an Opportunity Zone fund into the redevelopment of a project that is subject to GIPLET have any additional limitations or restrictions that weren't discussed in your leased property guidance?
I mean, we've done a deal with Opportunity Zone financing and GIPLET financing. And so the way the GIPLET works is you're transferring title to the municipality, but for tax purposes, you're still the beneficial owner of that. And so you haven't really done anything for tax purposes. So, so this would work with a GIPLET project.
Any additional limitations or restrictions?
The only thing that I came across was with the lender had more restrictions because it was a GIPLET deal, and one of those restrictions was with respect to the cash. So the problem with this program is you can't be building up cash at the Opportunity Zone business level. You need to be able to distribute that cash. So our lender, for whatever particular purposes, wanted a bigger cash reserve than the program will allow. So.
Okay. How can debt be used in a single asset fund?
Like any other deal.
Yeah.
Okay.
And the only thing you can't do is do something snarky like acquire a building and then refinance it 3 months later and pull all your money out or that kind of stuff. There's a 2-year limitation to that.
2 years.
So you've got to hold the original investment for 2 years and then you can refinance part of it out or all of it out or whatever you do.
Yeah, we're starting to see banks creating special lending and deposit project or products for opportunity zone deals. And part of that is they do get the benefit from meeting the CRA requirements. So they're actually pretty excited about lending into opportunity zone deals.
So you're talking about community investment.
Yeah, see, correct.
Yes.
Can an opportunity zone fund or investor pledge an opportunity zone asset or ownership to secure a loan?
No, because the investor won't own the asset. The investor could potentially
But can
pledge
the
their
fund do
interest,
it?
but they,
Because the
the
fund
fund owns the asset. The investor could pledge his or her interest in the fund if that has any collateral value, but not the asset itself.
We worked on this particular issue with two particular investors, and it's still unclear, but there are banks that lend on private equity positions, and that's all it is. It's a private equity investment into a portfolio of real estate. So we just have to find the right lending institutions, and theoretically they can borrow against their position. And a lot of people want to do that because they're willing to pay a couple % interest rate on their position to get liquidity back from the thing they just tied up for 10 years.
Okay. If an opportunity zone fund loses money, is that passed on to partners in a limited partnership structure?
Loses money because of depreciation deductions. It does
All
pass
I've got is
through. Yeah,
loses
so
money.
it does pass through, but the one thing to take into account is when you normally invest in an asset, you have a tax basis based on your investment. So if I invest $5 million into a fund, that means I could take out $5 million in losses. They pass through to me. When I invest in an opportunity fund, I have zero basis. So that means I get allocated losses, but I can't pass them through to me until I get basis when I get my income tax recognition hit in 2026. So I'll get a little bit at 5 and 7 years as well. So there is a trade-off with depreciation. You have to factor in that when you do one of these deals, you might not get the depreciation. You get allocated the depreciation. You can't use it as quickly as you can in a normal deal. So you got to take that into account. Not to make things more complex, but when you do take out debt, you do get basis for that debt. So debt will free up some of those losses. Not all of it, but some.
Okay, well, I'm going to ask a related question then. Is depreciation allowed on opportunity zone business and real estate assets?
Yes.
So that was nice and easy.
Another way to think of it would be as an investor in a complex, like heavy redevelopment of a commercial asset, I might depreciate your investment fully after 5 years or so, right? Kind of that's how the schedule works. So if I put 100,000 in, I'm getting $100,000 worth of losses over a 5-year period that sort of starts big and then shrinks a little bit. If you're looking at in the opportunity zone program, that might stretch over a much longer period of time. You still get them, but it just takes longer.
Okay, this looks like an easy one, and I might even take a shot at it. You guys correct me if I'm wrong. Do the capital gains need to be invested or rolled over by the end of 2019? Is there an extension? Do they have to be put in by 2019? No, but that's the maximal benefit if you get them in by 2019. And you do have to get them in 180 days after you realize your gain, or in accordance with the 1231 rules and whatnot. There's some other ones similar to that. If you're in a hedge fund or other partnership where you just don't know till the end of the year what your gains are, you go to December 31st, it's 100 days after that, 180 days after that. But is there going to be an extension? We know that there's an intention for there to be one, but as of this moment, there is not one.
I mean, there was a lot of talk last week at the conferences about legislation. I have not seen anything yet, but.
Yeah, I had some chats about it yesterday, but I don't see anything that's actually on paper in the system ready to go.
Right.
One thing that's important not to get lost in that is that there will be significant investment in 2020, 2021, and 2022. Why? Because, I mean, you don't get a deferral and a reduction of your tax when you invest in a Roth IRA, but you get that, you don't have to pay tax on the future gains. People do that for a reason, right? And that's a significant benefit. So I think people will invest in the program all the way up until the deadline of 2026. So if you have an asset and you're like, oh, maybe I'm going to sell my business this year, but you don't think you'll get your gain until next year, there's no reason not to consider the program.
I mean, it's really, what do you lose if you don't invest by the end of this year? You lose 5% reduction in capital gains. You still get the potential for 10. You still get the deferral.
Yeah, I tried really hard to emphasize that it's not the end of the world if you miss the 2019.
Yeah, I think it shaves like 20 basis points off of your boost. It's pretty small.
But a lot of people look at that reduction as a hedge against tax risk, tax rate risk, because the tax rates that apply in 2026 I mean, the 2026 gain, you're going to apply the rates in 2026. So that reduction is helpful because it allows you to hedge that.
Okay. Next question. Has anyone run a model to see if opportunity zone tax benefits outweigh depreciation deduction?
Yes.
Yes.
Many people.
They significantly outweigh that.
Yeah. Yeah. I mean, it's still a positive yield. I mean,
Would you recommend a particularly easily accessible public version of that someone could look at?
I mean, you know, we work with the Novogradic accounting firm. They run a lot of models for our clients right now. And they do a good job because they take into account all the different.
And they've got some hypotheticals on their website, if I recall correctly.
They do.
Yeah, we've run all of our models from them, and every single time it's standard investment versus it's just not even close.
Right.
So question submitter, if you're still listening, you'll see on this form more information. It says that I was relying heavily on Michael Novogradic. If you Google the phrase Novogradic, you will find their website.
Yes.
And lots and lots of opportunity zone material.
www.novoco.com.
Okay, we've got more rolling in. Folks, if you have a question, please get it in because we are going to try to wrap up on time. So we're going to close the submission of questions soon, so please get them in. I would like to open an equipment rental business with $1 million as inventory. Does this investment qualify if I transact at my opportunity zone based business, but the hand cement mixer is used outside of the opportunity zone to build a patio?
Well,
That's a great question.
I mean, one of the issues is whether that would be opportunity zone business property, right? Because you have to use it 70%. You don't know if it's 70% of the hours in the opportunity zone. It's 70% of the use, right? So one of the questions that I have that's going to be in a comment letter that we're submitting is going to be, what does that mean? Like if I bring the equipment back each evening and I store it in the zone, do those hours count?
If you're charging it, does that count?
I don't know.
Okay. Can a partnership roll its net 1231 gains into an opportunity fund, or do 1231 gains have to be flowed to the partners for netting and recapture of prior 1231 losses?
1231 gains are netted at the partner level. So you have to take that into account at the partner level.
Okay. Would a joint venture with a landowner qualify as an opportunity zone investment? If so, how would the tax benefit be distributed?
A joint venture with a landowner, so an opportunity fund investing in a land with a landowner.
Let's say for the sake of argument.
Yeah, so
yes.
I mean, we're seeing this right now where, funds are investing in third-party developers, and the interesting thing about that is that the third-party developer would be the opportunity zone business. So they have 5 requirements that they need to meet at the opportunity zone business level. But if they fail those requirements, the penalty is not on the developer, it's on the fund. So you have to, what we're seeing is a negotiation regarding an indemnity where the fund is asking the developer to indemnify them.
Well, and it's not on the fund, it's
for
on the
mismanagement.
investors, really.
Yeah, that's right.
Ultimately,
So it makes for interesting negotiations. The negotiations we were having were pre-regs, and the answer we were getting from developers were that we didn't have enough guidance to be able to give that indemnity, but that has changed.
Well, let me ask you a question that this triggered for me, and I'm going to ask this before I go to the next one. I have heard some folks talking about investing with nonprofit/philanthropic entities that are assigning their tax benefits to another partner. Is that doable? Or am I misunderstanding what I'm hearing?
I mean, you could do a joint venture with a nonprofit and have that be the opportunity zone business, where the opportunity fund will invest in an LLC and the nonprofit's the other member of the LLC.
All right, next question. I own and operate an aviation company in an opportunity zone. If I secure another lease from the airport and develop more hangar space, would this be qualified use? I'll take a shot at that one, Dan.
Yes, yeah, it would be called.
It seems like it, right?
Yeah, makes sense. Expansion.
So, now are they going to have to deal with the pre-17, post-17?
Potential. So was the question acquire under a current business or a
Well,
subsidiary?
here's the exact wording, and
Yeah,
that's
know.
kind of what I got.
Yeah.
I own
Best
and operate an
practice.
aviation company in a zone, so it's an existing business. If I secure another lease from the airport and develop more hangar space, would this be qualified use?
Yes, it would be qualified use, but you may run into issues with it being an existing business.
I want to add to that this is something that we talk to investors about a lot, which is, this person may want to invest in this expansion of their business. Well, what you need to understand is that you actually need to set up your own opportunity zone fund. You need to manage your own opportunity zone fund. You need to report to the government twice a year. There's a lot of work that's involved there. So, it's not just just because I have a qualified activity, I can put money into my activity and I'm done. You have to actually create an entire infrastructure and a fund structure, or you have to decide to partner with an existing opportunity zone fund and have them invest in your business. Those are the two things. So if you don't want outside investors, you've got to run your own opportunity zone fund, and I highly recommend these gentlemen to do your legal work for you, and good luck. And if you do want to do this expansion, you need to accept the fact that you're going to be taking on money from an outside investor. And you can invest in their fund and you get exposure to your own project. But you have to have an intermediary somehow, and that could be a fund that you run or a fund that you invest into.
You could also potentially joint venture with the fund and you retaining a stake in the existing business too.
Yeah, absolutely.
Next question. A business, a UPS store, is to be sold this June. The down payment will cover the initial investment and the seller will recognize gains from the sale. In addition, the seller will also recognize gains monthly for the next 8 years, according to the sale agreement. What is the best way to invest these monthly gains to a qualified opportunity fund, and how will these be reported?
So it sounds like they're going to be on what we call the installment sale method. So each month they're going to generate a gain. So that is an eligible gain each month. So, they can.
So they'll have 180 days from each time they get
from
that.
each time.
Yeah, and they can invest all that in one fund, or they can spread it across multiple funds across the country.
All right, we're getting a lightning round here. Our family has a hotel site in an opportunity zone. What is a good strategy to use this tool to build, and it just says build, hold for 10 years. I'm assuming that's build and hold for 10 years.
Well, if it's an existing property, it's a bad asset, but you're allowed to have.
It sounds like it's a site that they would have to build.
So they don't have an existing hotel.
Well, you can't ask this.
So
they own the site.
Same answer as the airport guy. You've either got to decide if you're going to start a family fund and do your own investment, or if you're going to partner with an outside fund. That's it.
But the bottom line is, just because you have assets that you owned, pre-2018, you still can participate in this program.
Yeah.
But you have to do the math. So if the site is worth $1 million, you need to put $2.5 million into it, right? So to get into your 70-30 proportion.
Okay. Any comments regarding carried interest / services? For example, furnishing services to a qualified opportunity fund does not qualify as a reinvestment of capital gains. How does this impact the GP, in parentheses, developer, who puts in sweat equity and puts down small amount of capital and after 10 years has large gain? Because most of the gain is from sweat equity, are they taxed fully on that gain?
We see this a lot where pre the regulations, a lot of our clients were putting in like 1% of the capital and then taking a carried interest of 20%. And the answer on that is that 19% carried interest will not qualify because it wasn't an investment. It was an investment into the fund. It was you received that 19% in exchange for services you either performed or will be performing for the fund.
We are developing a solar facility on land partially in the opportunity zone. And I happen to know this one, so it's partially on that and then contiguous land that's not. If we put the office's substation and battery location on the opportunity zone land and the PV panels on the non-opportunity zone land, will the entire project qualify for an opportunity zone investment?
Just might go back to whether more of the project is on opportunity zone land than off of it. It's more on it.
So it's a square footage
It's a square footage question, and then it goes to a value question.
Yeah, it goes to cost basis. But I think the gist is that these regulations were very favorable to renewable energy, and so before we were worried about, because when you sell a renewable energy asset, it generates ordinary income, and so folks were worried about whether ordinary income would qualify here. And so the bottom line is, if if I invest in a qualified opportunity fund and I sell that interest in the fund, then if I have any assets inside the fund that generate ordinary income, I still get that basic step up at the end of 10 years. What I can't do is sell the solar facility separately. I don't get, their ordinary income does not get the 10-year benefit.
But clearly, from a square footage standpoint, the actual array, the solar panels are going to use up a lot more physical square footage than the battery storage area.
Correct.
So, I mean, in that case, if that's what your definition is.
It just goes to the second set of regulations. You'd have to count the number of square feet actually in the opportunity zone. If there's more in than out, probably would be okay.
If the capital gains are invested in 2021, will that get the benefit of a 5-year 10% reduction or lose the benefit overall since it is after 2019?
No,
Right?
you get the 10.
You get the 10%. Good news. Okay, last question. I'd like to joint venture a landowner to develop apartments in his land. Would this qualify or would there be a problem regarding old ownership?
Say that again.
I think what this person wants to do is have a joint venture with a landowner to develop apartments on the landowner's land. Would this qualify or would there be a problem regarding old ownership? I think this is more of a related parties issue if the landowner still owns the land.
Well, I mean, it could just be a bad asset. I mean, when you have related party transactions, you just end up with a bad asset. So you're in that 30% bucket. So the one thing that people have to understand is that in that once you're dealing with the 30% bucket, to the extent you pay developer fees or any type of construction fees, that also creates a bad asset because that's usually paid to a related party. You know, so
Our option 2, right, sells to a JV in which the landowner has 20% or less.
So it sounds like the better option would be to sell the land into a joint venture where the landowner is 1/5 of the ownership.
Yeah, you want to write related party if you can.
Yeah.
But
Yeah, that related party stuff, that's a whole call your lawyer question. That's when I get those, I just send them right on to you guys. Okay, it does, oh wait, we have another one that just rolled in. We'll make this our last one. We own and develop triple net lease properties. Are there any advantages for this property type?
I mean, yeah, I mean, the triple net leasing is a big issue, but Treasury is really looking at it from you have to do something on the property. So again, if you have maintenance obligations, that should be enough.
I want to thank everybody for being here and squeezing in around our conference table to be part of this conversation. I want to thank everybody who was listening in their offices or at home or in their car. I'll point out again on this for information page, we've got our Opportunity Zones page. We will post this webinar up there later. We also have links to the Arizona Opportunity Zones Network, which is a great place to share your expertise or look for expertise, to find lawyers like the ones we have here, to find fund sponsors like the ones we have here, find economic developers and philanthropists like the ones we have here, because these are the folks who can really help you. You can also share your expertise. You can find expertise. You can find projects, land for sale, businesses that need investment, land for lease. And you can also post your own and put your funds up there because we really appreciate that. And we want to really do everything that we can to connect the Opportunity Zones community writ large here in Arizona so that we can maximize the impact of this tax provision on our communities across the state. Thank you very much. We appreciate it.
thank you.
Thank you. Chris, can you share this one? So, or just stop share.
Oh, yeah, absolutely.